General Motors shares, you can see, down over 3% this morning after news the company is set to take a multi-billion-dollar charge tied to scrapping many of its plans around the production of EVs. From Ford and GM in 2026 and 27, what are they actually going to be producing?
Well, it's going to be dramatically lower than what we've seen in the past couple of years. For General Motors, its fourth quarter EV sales were down 43%.
There's a memo. It exists. We can't tell you who sent it, but it came out of General Motors' Manufacturing and Sales Division in mid-March. It's addressed to regional sales directors across North America. And it says something that nobody outside of GM has said out loud yet. We have approximately 60,000 units of Silverado and Sierra inventory with no clear path to customer placement. That's corporate speak for, we made way too many pickup trucks and nobody wants to buy them at the prices we need. 60,000 pickup trucks. That's 17 Silverados and Sierras sold every single minute, 24/7, for an entire month, just to clear current inventory. GM doesn't move 17 trucks per minute, not even close. They move about 4 per minute across all markets, all geographies, which means that at current sales pace, it will take 4.5 months just to move what they've already built. And they're still building more. This is the kind of inventory crisis that kills companies. Not immediately. But over the next 18 months, when GM has to mark down prices to clear inventory, when dealer relationships with other manufacturers dry up because dealers are stuck with Silverados they can't move, when brand value erodes because discounts become the only way to sell trucks, that's when the real damage happens. We're watching the beginning of the end of General Motors' profitability in the truck segment. The irony is breathtaking. Ford saw the soft demand for trucks in early 2026 and adjusted production. Ram saw it and adjusted. GM didn't. Or maybe GM did and corporate overrode the decision. We don't know which is sadder, but the result is the same. GM is about to get clobbered by the market, and truck buyers are going to get hammered by 60,000 trucks flooding the market looking for homes. Here's what's happening, why GM made this catastrophic mistake, and what it means for anyone thinking about buying or selling a truck in the next 6 months. Because the ripple effects of this are going to reshape the truck market in ways that hurt truck owners and dealers while momentarily helping truck buyers. But the moment is temporary. And then the reckoning comes. The manufacturing decision that broke everything. Let's think like General Motors for a second. In late 2025, GM's manufacturing team was deciding production volumes for the first quarter and the second quarter of 2026. They knew the market was soft. They knew demand was softer than 2024 and 2025. But they made a decision. Build more trucks anyway. Why? Because the truck segment is where the margins are. A Chevrolet Silverado can generate $8,000 to $12,000 in profit per unit. That's before dealer markup. That's GM's profit. A Chevy Malibu generates $3,000. A Chevy Blazer generates $5,000. So, if you're a manufacturing executive, you see trucks as the profit engine. The flaw in that logic is that the market doesn't care about your margins. The market cares about demand. And demand for new pickup trucks in the first quarter of 2026 was down 9.7% year over year. That's a significant drop. Ford and Ram both saw it coming and adjusted production downward. They built fewer trucks. GM didn't. Or they started building before the demand data came in and couldn't stop the assembly lines fast enough. The result is inventory that accumulates faster than it moves. When inventory accumulates, dealers get angry because they're carrying too much stock. A dealer with 30 Silverados on the lot isn't a happy dealer. A dealer with 50 Silverados is desperate. A dealer with 70 Silverados is actively looking for another franchise. GM's dealerships across North America are carrying too much truck inventory. Some are paying financing charges on vehicles that have been on the lot for over 100 days. That's killing dealer cash flow. A Chevy dealer in Texas told us off the record, "I've got 43 Silverados sitting on my lot right now. I'm paying finance charges of about $300 per vehicle per month on inventory that's over 100 days. That's $13,000 a month I'm spending just to hold the inventory. GM is not helping us move it. They're not offering incentives. They're not adjusting production. They're just creating the inventory crisis and expecting us to figure it out." That's the dynamic from the dealer perspective. From GM's perspective, they're hoping that production will stay ahead of demand, that dealers will be forced to drop prices, that price drops will create demand, and that everything will eventually clear. It's a dangerous game. Because when dealers start getting desperate, they either cut prices so aggressively that brand value erodes, or they stop ordering from GM and start looking at Ford and Ram. What consumers think versus what's actually happening. Most truck buyers think the truck market is strong. They see Silverados everywhere on the road. They see Ram 1500s and Ford F-150s. They assume the manufacturers wouldn't be building this many trucks if people weren't buying them. That's the consumer's error. Manufacturers build trucks because they're profitable, not because the market is buying them at the rate production is running. A car can sit on a dealer lot for 100 days, and most consumers will never notice because they're not looking at inventory levels. They're just looking at what's available when they want to buy. But inside the dealer network, what's happening is completely different. Salesmen are getting angry because they're expected to move more inventory than the market will absorb. Finance managers are getting angry because they're paying holding costs on vehicles that should have sold 3 months ago. Dealers are getting angry because their capital is tied up in excess stock. And GM is getting angry because dealers are demanding help that GM can't provide without destroying margins. The way you solve this problem is with price. You cut prices on trucks until demand matches supply. But if you cut prices, you trigger a cascade. Trucks that sell for less today are worth less in the used market tomorrow. That hurts truck owners. That hurts residual values. That hurts leasing companies. That hurts everyone who owns a truck that's not brand new. So GM is trying to avoid cutting prices. They're trying to maintain brand value. But that maintenance of brand value comes at the cost of accumulating more and more inventory. Incentives are the middle ground, and GM is starting to lean there. In April 2026, GM increased truck incentives to an average of $2,200 per truck across the Silverado and Sierra lines. That's double what they were offering in February. But even with the incentive, inventory is moving slower than production. So we're in a phase where GM is ramping up incentives, trying to match supply to demand without cutting prices, and it's not working fast enough. April 2026. When incentives become desperation. The conventional wisdom used to be that incentives don't hurt brand value. Give a customer a $2,000 rebate, and they still paid list price minus the rebate. They think they got a deal, not that the manufacturer is desperate, but there's a limit. When incentives get to $4,000 or $5,000 on a truck, the market understands what's happening. They understand there's too much supply. And they understand that if they wait a few weeks, the incentives will get bigger. GM is probably going to hit $4,000 in incentives per Silverado by June if inventory doesn't start moving. At that point, what you're really doing is cutting prices without calling it price cutting. The manufacturer is the same. The dealer margin is the same. The end price to the consumer is lower. And the brand suffers because the truck that was $58,000 is now effectively $54,000, and everyone knows it. The ripple effects are immediate. Truck buyers figure out that incentives are getting bigger, so they wait. They don't buy in April. They wait for May because they know May incentives will be higher. So demand drops further. GM has to increase incentives further. So more buyers wait. This is the death spiral. It starts with bad inventory forecasting and ends with a manufacturer begging dealers to move trucks at whatever price the market will bear. The used truck market gets hit hard when new truck incentives spike. If a brand new Silverado that was selling for $60,000 is now effectively $56,000 with incentives, then a 3-year-old Silverado that was worth $48,000 is now worth $44,000. The value drops immediately because the new truck is closer in price. Used truck owners lose value. Dealers with used truck inventory get hurt. The Ford and Ram contrast. Ford saw the demand softening in January and February and reduced Silverado and Sierra production immediately. Ram saw it and adjusted production. Both manufacturers understood that building more trucks than the market will absorb is catastrophic. GM did not understand, or corporate overrode the decision, or the manufacturing team could not stop the production fast enough. The result is that Ford and Ram are going to come out of Q2 with much leaner inventory and stronger pricing power. When Ford has less truck inventory on dealer lots, there is more customer demand chasing fewer vehicles. When there is more demand chasing fewer vehicles, Ford can maintain or raise prices. When Ford is raising prices while GM is cutting incentives, Ford's profit per truck goes up and GM's goes down. Over a year, the difference between building the right amount of inventory and building too much is probably $500 million in profit. The competition dynamic shifts. Right now, in April 2026, if you are shopping for a truck, a Chevy dealer is going to fight harder to sell you than a Ford dealer will. The Chevy dealer needs to move inventory. The Ford dealer does not. So the Chevy dealer will give you better incentives, better financing, better service packages, anything to make the sale. If you are a consumer, this is great. You get a good deal on a Chevy truck. But you are buying into a market where the manufacturer has already made a mistake, and that mistake is about to play out over the next 6 months. Ram is in between. Ram has more inventory than they want, but less than Chevy. Ram is probably going to come out of this with healthy inventory levels and good profit. Ford is going to come out of this with amazing profit because they saw the problem coming and acted early. Chevy is going to come out of this with higher incentives, lower margins, and angry dealers. That's the executive decision cascade. One bad manufacturing forecast made 3 months ago probably cost GM $500 million in profit. The dealer perspective, inventory trap. A truck dealer doesn't get to choose how many trucks to stock. GM's franchise agreement basically says, "We're delivering these trucks to your lot. You owe us for them once they're there." The dealer has to finance them. The dealer has to maintain them. The dealer has to sell them or die trying. And right now, dealers are dying. Not literally, but their capital is tied up and bleeding. The mechanics of dealer financing are brutal. A dealer borrows money from a financing company, usually a captive finance company like General Motors Financial, to buy trucks from GM. The dealer owes that money, whether the truck sells or not. If the truck sells quickly, the dealer gets the cash and pays back the loan. If the truck sits, the dealer keeps paying interest on the loan with money from other sales. It's a razor-thin cash flow situation, and when you've got 40 extra trucks on the lot, you're bleeding maybe $15,000 a month in financing charges on excess inventory. A dealer group with 5 locations and 100 Silverados on their lots is probably paying $45,000 a month in excess financing charges. Over 6 months, that's $270,000. That's not coming out of manufacturer profit. That's coming out of dealer profit. So while GM is waiting for the market to absorb inventory, their dealers are actively suffering. The dealer revolt is quiet but real. Some Chevy dealers are talking to Ford about franchise agreements. Some are threatening to reduce their truck allocations in the future. Some are actively marking down trucks aggressively just to turn them into cash, even if it means taking small losses. and GM is not helping. They're not even offering dealer support in the form of extended warranties, trade-in guarantees, or aggressive buyback programs. They're just letting dealers hang. The used truck market collapse. When new truck incentives are this aggressive, used trucks suffer. Simple economics. If a brand new Silverado costs $56,000 with incentives, nobody's paying $48,000 for a 3-year-old Silverado. So the used market drops. A 2023 Silverado that would have been worth $48,000 in February is now worth $43,000. A 2022 Silverado that would have been worth $42,000 is now worth $37,000. The values fall because the new truck is too close in price. People who bought trucks in 2023 and 2024 thinking they were good investments are now looking at $5,000 to $8,000 losses in equity. That's frustrating. That's painful. And it's directly caused by GM's manufacturing mistake. If GM had built the right number of trucks, there would be no desperate incentive situation, and used truck values wouldn't have collapsed. The cascade continues. When used truck values fall, owners are less likely to trade in their trucks because they're underwater on their loans. They keep their trucks longer. That reduces the supply of good used trucks in the market. That should help the used truck market, but it doesn't, because the supply issue is being more than offset by the incentive problem. New trucks are cheaper. That's the fundamental issue. And until the 60,000 unit inventory is cleared, the used market stays depressed. Some dealers are trying to weather it. They're holding used truck inventory, betting that in 6 months, when the new truck inventory clears, used truck values will recover. Maybe they're right, but the financing costs are killing them in the meantime. And if used truck prices drop another 5 to 8% in the next 3 months, they're going to take losses they can't recover. The risk is entirely on the dealer. The decision was made by GM. What actually caused this? The simplest answer is bad forecasting. GM's manufacturing team looked at demand in late 2025 and probably predicted that demand would be flat or slightly positive in early 2026. The actual demand was down nearly 10%. That's a significant miss. Whether it's because the economic impact of tariffs was worse than expected, or because consumer confidence dropped, or because buyers decided to hold on to their current trucks longer, the forecast was wrong. And once you've started production on 60,000 units, you can't stop immediately. The trucks keep rolling off the assembly line. But there's probably a deeper issue. Truck margins are enormous. A Silverado generates more profit per unit than almost any other vehicle GM makes. So there's an incentive to build trucks, even if the market is soft. It's like a gambler who keeps doubling down because the previous bet paid off big. The truck segment has been so profitable for so long that decision makers probably underestimated the risk of overproduction. They thought, worst case, we discount a little and move the inventory. They underestimated how much discounting would hurt the brand and the market. There might also be political pressure. GM employs thousands of people at the plants that make Silverados. If you reduce production, you're reducing shifts, laying off people, or idling plants. That's politically unpopular with unions, with state governments, with local communities. So there might have been internal pressure to keep plants running at full capacity, even if demand didn't support it. We don't know. But that's a pattern in manufacturing. When you have excess capacity, you use it, even when it doesn't make business sense. The only certainty is that someone at GM made the decision to build 60,000 trucks when the market would only absorb 40,000 in the same time frame. That decision costs the company hundreds of millions of dollars in lost profit, ties up hundreds of millions of dollars in capital, and causes pain for dealers and consumers. It's a mistake. A massive, obvious, painful mistake. And now, everyone else has to deal with the consequences. The time frame for impact. The 60,000 truck inventory won't clear overnight, but it will clear. Incentives will keep rising until demand matches supply. By September 2026, most of the excess inventory is probably gone. But the brand damage lingers. Buyers associate Chevy trucks with desperate incentives. That becomes the narrative. You can get a great deal on a Chevy because they're overstocked. That narrative is good for buyers short-term, but bad for GM long-term because it trains consumers to wait for discounts. From now until September, we're going to see escalating incentives on Chevy and GMC trucks. We're probably going to see some pricing pressure on used trucks. We're probably going to see some dealer exits, dealers who decide the truck segment is not worth the capital tie-up. And we're probably going to see Ford and Ram gain market share because they're the competent manufacturers who saw the problem coming and acted. The incentives probably peak in June or July. At that point, it might be the best time to buy a truck if you're in the market. The incentives are at their highest. The inventory is starting to clear, and the manufacturer is desperate enough to give you great terms. But if you're a current truck owner, the timing is bad. Your truck's resale value is in free fall right now. Waiting 6 months doesn't make it better. The depreciation has already happened. It just won't get worse. By October, the inventory is gone and the incentives drop back to normal. Truck pricing stabilizes. Used truck values stabilize. And the truck market returns to a healthy equilibrium. But the damage to brand perception lingers. People remember that Chevy needed to offer $5,000 incentives. That memory stays. What this tells us about manufacturing. This situation is a reminder that manufacturers are not magical entities that know everything. They're human organizations that make mistakes. Big mistakes. Expensive mistakes. The fact that General Motors, one of the biggest automotive manufacturers in the world, can accidentally build 60,000 trucks it can't sell in a reasonable time frame, tells you that even the largest companies are vulnerable to bad forecasting, bad management, or bad luck. It also tells us that the industry consolidation we're seeing is probably justified. Smaller manufacturers don't have the capital to survive mistakes like this. Only big manufacturers with diversified portfolios can absorb a $500 million error and keep operating. Smaller companies would collapse. So the incentive is to consolidate, to merge, to get bigger so you can survive mistakes, which is probably contributing to the smaller number of manufacturers we see today. But the real lesson is about market power. GM has so much market power that they can make a massive mistake and the market has to adjust around them. Dealers have to carry the inventory. Used truck owners have to absorb the value loss. Consumers have to wait for incentives to clear. Nobody can force GM to acknowledge the mistake or compensate the people harmed. They just have to deal with the consequences. That's the darkest part of this story. It's not that GM made a mistake. It's that there's no mechanism to hold them accountable for the mistakes they make. The truck buyers, the truck owners, the truck dealers, they're all absorbing the cost of GM's forecasting error, and there's nothing they can do about it. If you're shopping for a truck right now, do not buy a Chevy or GMC truck at full price right now. You're making a mistake. The incentives are about to get bigger. You're going to feel stupid in 4 weeks when the dealer you bought from is advertising an extra $1,000 off. Wait, let the market sort this out. By June, the incentives are going to be substantial enough that buying a truck is actually a good decision. Right now, it's a mediocre decision that gets better in weeks. If you own a truck, understand that the resale value hit has already happened. Your truck is worth less. That's painful. But it's not going to get much worse because the rate of depreciation is normal after the initial shock. So you're not losing more money by holding it. You're just processing the loss that's already there. Keep it, use it, sell it when you're ready. The market won't reward you for waiting because the values are already adjusted down. If you're trading in a truck, The dealership is probably offering you a low price because they know used truck values are falling. They know the truck is worth less because of the new truck incentive situation. So the trade-in offer you get is reflecting their risk. You're not getting robbed. You're getting market price for a truck that's suddenly worth less. It's unfortunate, but it's real. If you're buying a used truck, now is a great time. Used truck values are soft. Dealers are motivated because they've got too much new truck inventory and they want your cash. You can negotiate hard. You can get a good deal. But understand that you're buying into a market where new truck incentives are creating pressure. In 6 months, when the new truck incentives drop, used truck values will stabilize. You might see another few percent drop before then. So buy if you need a truck. Don't buy if you're speculating on used trucks as an investment. Download our free guide, 10 car brands to avoid. Links in the description. Because understanding which manufacturers are stable and which are about to hemorrhage market share due to inventory mistakes is critical when you're buying. GM just demonstrated that they're capable of massive strategic errors. That doesn't mean you can't buy their trucks, but it means you should understand the risk you're taking.